When I say quantitative finance, there is a good chance you are picturing something like this. Data comes in, a signal fires, a trade goes out. And that is part of quant finance. But if you think it is the whole job, you are missing most of the system. Around that one signal sit data, models, risk, execution, and a great deal of machinery nobody puts on a slide. The trading signal may be the smallest part of it. And this is exactly why quantitative finance feels confusing when you are trying to learn it. You hear about Python, statistics, options, machine learning, portfolio optimization, time series, Monte Carlo, backtesting, and nobody ever shows you how any of these pieces fit together. So rather than another list of quant topics, we are going to build one complete mental model. I call it the Quant Engine. 8 layers separate a financial question from a real quantitative system. And the 7th layer is the one that makes a lot of beautiful looking strategies completely worthless. Before we build it, let us define the field. Quantitative finance is what happens when you take a financial problem and make it measurable, using mathematics, statistics, data, and software, not mathematics for its own sake. The equation exists because there is a financial question underneath it. Layer 1 is the question. A quant rarely begins by asking which complicated model to use today. A useful process starts with something financial. How much could this portfolio lose? Is this option mispriced? How should we allocate capital? What does order flow say about liquidity? And how expensive will this trade be to execute? And that explains something people find confusing. 2 people can both be called quants and do almost completely different work. A researcher, a risk quant, a pricing quant, a quant trader, a quant developer. The word describes a way of solving problems far more than it describes one single job. Layer 2 is data. And this is where a lot of beginners jump straight to the model. Because before you ask which model to use, there is a smaller question that has to come first. What information was actually available at the time? A quant might work with trades, quotes, order books, fundamentals, interest rates, economic data, or alternative data sets. 7 very different feeds, and every one of them has to be cleaned, aligned, and turned into something a model can read. But financial data is not only messy, it can quietly make your research lie. A company can disappear, a ticker can change, a stock can split, a number can be revised months after the fact, and you can end up using information that nobody actually had at the time. So the real question is always the same. What did you know and when did you know it? Because a brilliant model built on incorrect data is still an incorrect system. Bad data beats good math every time. Now we finally reach the model. This is where mathematics and statistics enter. Regression, time series, probability, optimization, machine learning, simulation, but none of these are trophies. They are tools. Use the simplest one that actually answers your question. Say we ask whether recent price momentum tells us anything about future returns. Prices become returns. Returns become a momentum score. The score gets lined up against what happened next, and the whole thing goes through a statistical test. Now we have something testable. Not, I think this chart looks bullish, but here is exactly what momentum means, exactly how it was computed, and exactly how we are going to check it. But models do not automatically produce decisions. Suppose yours predicts an expected return of 4%. What do you actually do with that? Buy? Ignore it? Take a small position? A large one? Hedge it? The prediction is not the decision. In a trading system, the path might look like this. Market data, features, model, signal generation, position sizing, risk checks, order, and notice something about that list. The signal is one box. A strategy is not a signal. Or maybe the decision is not buy against sell at all. Maybe the question is how much of each thing you should own. An optimizer takes expected returns, volatility, correlation, constraints, and costs and turns all of it into weights. A portfolio quant is not deciding whether one asset looks attractive. They are deciding how hundreds of positions should behave together. And this is why 100 assets do not necessarily give you 100 independent bets. Some of them move together. When they do, you are holding the same risk several times over without noticing it. Diversification is about relationships, not about counting names. Layer 5 is the one that separates an interesting model from a financial decision. Risk. because the question that matters is not only what happens when I am right, it is what happens when I am wrong. Two strategies can deliver exactly the same return while putting you through completely different experiences. Both of these made 10%. One of them never fell more than 5% along the way. The other fell 45% and then recovered. Return on its own does not tell you which one you just bought. So quants measure volatility, correlation, drawdown, tail loss, expected shortfall, and how a position behaves under stress when markets stop behaving the way they usually do. A lot of quants are not trying to predict tomorrow's return at all. They are trying to describe tomorrow's possible losses. And the same engine runs in derivatives. The question becomes, what should this option be worth? The data is a spot price, a strike, a time to expiry, an interest rate, and a volatility. The model is a pricing engine. The output is a number. And then come the sensitivities, delta, vega, gamma. A derivatives quant often cares less about predicting direction and more about what happens to that price when the world moves. Layer 6 is execution, because deciding what you want and actually getting it are two different problems. If your model wants 1 million shares, the market is not going to politely hand them over at the price on your screen. There is only so much resting at the best price, and then the next one, and then the one after that. So you take the best price, then you take the one above it, then the one above that. By the time the order is finished, the average price you paid is worse than the price you saw when you decided. The act of executing moves the price itself. Your order becomes part of the market. So execution quants ask a completely different set of questions. How fast should we trade? How much liquidity is actually there? Should the order be split into children? Which venue should receive each one? And afterwards, how much did the execution itself cost us in slippage and impact and in fees? A decision is not an execution. Which brings us to the layer I warned you about at the very beginning. 6 of them are filled in now. One is still empty, and it is the one that decides whether any of the work above it was ever real. Validation. This is where a beautiful quantitative idea gets asked one very uncomfortable question. Why should anyone believe you? A backtest turned 100,000 into 2.4 million. Wonderful. Now prove that the result means something. Imagine testing 1,000 strategies. Purely by chance, a handful of them are going to look incredible. If you only show me the winner, I cannot tell whether you found something real or simply found the luckiest experiment in the pile. Luck can look exactly like skill. Which is why serious validation worries about look-ahead bias, survivorship bias, data leakage, overfitting, transaction costs, and regime change. A strategy can survive every piece of mathematics in it and still fail right here. So we separate what the model is allowed to learn from what we use to judge it. We hold back data it has never seen. We walk forward through time instead of looking back at all of it. And we ask whether the result survives assumptions it was never built to exploit. The future has to stay hidden. This might be the single most useful change you can make in how you think about this field. A quant is not paid to produce impressive historical charts. They are paid to build decisions that survive contact with reality. A backtest is not reality. And finally, layer 8, engineering. Because even a validated model is still not a production system. The notebook that produced the result is not the thing that has to run on Monday morning without you watching it. Something has to receive the data. Check it, compute the features, run the model, apply the risk limits, store every decision, send the orders, watch for failure, and reproduce exactly what happened months later when somebody asks. A model is not a system. This is where quantitative finance and software engineering actually meet. A quant developer takes something that works in a research notebook and turns it into infrastructure other people can trust. Python, Java, TypeScript, streaming, cloud. The language depends on the problem. Correctness does not. So now we can finally answer the thing we opened with. What do quants actually build? Question. Data, model, decision, risk, execution, validation, engineering. 8 layers and every single one of them has to hold. They build systems, trading systems, portfolio optimizers, risk engines, option pricers, execution algorithms, volatility models, backtest engines, market data pipelines, and behind every one of those is some version of the same 8 layers. So yes, a quant might well build a trading signal, but now you can see how small that signal is next to everything it takes to make it useful. The model is only one layer. And that is exactly how we approach quantitative finance on the FinTech Builder. Take one concept, volatility, for example, and walk the whole way down: the definition, the assumptions, the formula, the data contract, the algorithm, and implementation in Python and in TypeScript, the tests, and where that piece actually sits inside a working financial system. We do not stop at what a formula means. But having the map creates a new problem. If you actually want to get good at this, what do you learn first? Probability, statistics, calculus, linear algebra, Python, market structure, time series, optimization, machine learning, derivatives. Learning those in the wrong order is one of the easiest ways to spend months on advanced mathematics without ever finding out what it was for. So next, we are putting the whole learning path in order: the maths, the coding, the markets, and the models.